right, guys, welcome back to another video. Today, we're going to talk about bonds. You've heard stocks and bonds, stocks and bonds. What's your mix of stocks and bonds? This is the other major security that is traded on the exchanges. And it's out there, it's public. So I'm going to break them down for you so you understand what these are. Now, if you remember stock, if a company wants to raise capital, they issue stock or equity in the company, ownership of the company. In exchange for money, you'll actually own a piece of the company and grow with it, good or bad, receive dividends, profit distributions according to the growth. So it's actually ownership. As you can see, owning a stock, there could be high growth, but there's also a high chance for loss, because if the company that you're invested in does really well, I mean, it can do extremely well, right? We look at some of the companies that come out over the last 2 decades and we just see how much they've grown. Amazon, since inception in the late 90s. Apple's been around a lot longer, but its growth like really started taking off, a little while after that. So it's been a couple decades since it's really been charging ahead. Tesla is like such a new stock and it's skyrocketed. So the potential for growth by owning a piece of a company is huge. But on the flip side, companies can go bad, right? They can go wrong. And there's a big downside. Essentially, the company could go under and you could lose all value in that stock and the stock become worthless, because the company is not worth anything anymore. When you're thinking about risk, stocks offer a potential. There's a bigger range of variability, higher highs, lower lows, just depending on the company, the economy, how it affects it, right? If everybody knew exactly what was going to happen in that stock, then, they would either all buy it or nobody would buy it. So there's a lot of factors that go into it. It's hard to predict, but that's why you get into stocks. You want to go for growth. You're looking for growth. On the flip side, there are bonds. Bonds are not equity. They are not ownership. A bond is simply debt. It's a loan. So if a company wants to raise capital, but they don't want to give away equity, they don't want to give away their ownership to raise capital, what they can do instead is they can just issue debt. And they say, hey, we want to raise $10 million in the form of debt. And what we'll do is we're going to set a certain term of this debt. So maybe it's 10 years or 15 years, and we'll have a set interest rate, and we will make you payments on that debt during the whole time. Maybe we'll pay a little bit of principal and interest the entire time. Maybe we'll just do interest only payments. And at the end of the term, then we'll give you a lump sum with your money back. But this is a way for companies to raise capital without giving up ownership in their company. Okay, so this works well if you're a cash flowing business, right? If you have consistent cash flows that you can service a debt, make your loan payments, then it could make more sense to do debt rather than equity. A lot of companies that take on equity actually don't have a lot of revenue and are reinvesting everything into growth and don't have the money to pay debt consistently. So they'd rather take on equity. They'll share some of the ownership of the company in exchange for not having to make consistent regular payments. Well, that works for some business models. Others, debt makes more sense. So good cash flowing business, it can make a lot of sense to raise capital using debt. So companies do this all the time. And even public companies, major corporations do this. In fact, the US government does this a lot. The US government issues all types of bonds of any duration, 1 month, all the way up to 30 years, anywhere in between. You can go and buy debt from the US government. So let's talk about the risk here and what are some of the factors that go into bonds, okay? Because bonds are a debt, they're an obligation, there's a set interest rate, generally speaking. It could be variable, but let's just call it fixed, because generally it's fixed interest rate. And you're like, yeah, I'll lend you $50,000 in exchange for this bond, and you're just gonna pay me interest on that and then pay me back at the end. Yeah, that sounds good. We can do that. So because you're not basing this investment on the growth of the company, you're not able to participate in all the growth. If that company goes 10x, you're not going to go 10x with your bond. You're still going to get your 5% payment from your bond. And so your upside is capped. There is a limit. It is a very set and defined limit, which also means that your downside is capped. If the company starts going into trouble, your bond is basically not affected. They're going to have to continue to make their payments to you. It is one of their obligations. If the company goes bankrupt, then there's a different story. So there is still some risk, because then they might not be able to pay back the bond at all. But generally speaking, it's lower risk. And so interest rates on these bonds are relatively low because you're not taking all the risk. You're not assuming risk of growth or decline of a company. You're simply agreeing to a set interest rate. So the US government, they issue a lot of bonds, and China owns a lot of the US government debt. Other nations around the world. One of the reasons is that the US government will pay their debt. They will make their payments payments. And so you hear often a guaranteed return. Okay, there are no guaranteed returns in investing. The exception is US government bonds. They are commonly known as a guaranteed rate of return because the government is not going to default. They're not going to go bankrupt and not pay on their debt. They never have until now anyways. And so because it's essentially guaranteed, interest rates are low. They're very low. If you tie up your money for 3 months with the government in a government bond for a 3-month duration, you're going to get very little interest. If you decide to do a 10-year bond or 20 or 30-year bond, the longer the term, the more interest they are going to pay you. So you might get a 3-month bond 0.25% interest, but you might get a 30-year bond at 3% interest, okay? Because you're tying up your money longer, they have to give you a higher rate of return. They have to pay you more for that risk that you're taking on. And so when you look at other bonds that are issued by not the government, companies, they base it on the rate of the 30-year treasury bond from the US government. So if a company's, they're going to issue debt, they base the rates that they pay on the prevailing market rates. Now, when a company issues debt, there is risk. It's not guaranteed. There is risk. Something could happen to the company. It could go under. For really large companies, maybe that's not very likely, but there's still a possibility. So maybe they increase the interest rate a little bit. So, okay, well, there is more risk because we could default on this. So we're going to give you a little bit higher interest rate. Then there are other companies, you keep going down that spectrum. There are other companies that are very speculative. Maybe they're very high growth or have very volatile growth, and they want to raise debt. In order for somebody to buy debt of that company, they have to offer a much higher rate of interest because there's more risk, right? There's a higher likelihood this company goes under. And so they've got to offer, 8, 9% on a bond. So these highly speculative types of bonds are called junk bonds. That's just the name. It doesn't mean that they're bad. It just means that they have low rating. So credit rating agencies look at these bonds, they look at the company and they issue a rating and they say, yeah, this is a AAA bond or it's a AA or it's a BB bond, right? They have all these rating systems and they're different for each credit rating agency. But essentially you can get an idea or a picture for how risky is this bond, and you correlate higher quality bonds with a lower interest rate, lower quality bonds, higher interest rate. Basically that simple. So higher the rating, the less risky it is, which means they can pay a lower interest rate. The lower the rating for a bond, the more risky it is, which means they have to pay higher interest to you. So that is what a bond is. It's just debt, not ownership. If a company does go bankrupt, they actually have to, and they liquidate assets, right? They have to sell property or equipment or whatever, and they have to liquidate and distribute money back out. Bond holders have higher priority than shareholders of the company. So if a company goes bankrupt, the people that own a bond in that company are first in line to get their money back. And all the way at the bottom are equity owners, stockholders. If there's anything left of the company after it's gone bankrupt and met its other obligations, then it's distributed to shareholders. It also has a more favorable position in a bankruptcy. You can see why bonds are just less risky. So when you hear stocks and bonds, we'll talk about this more about when we talk diversification, but stock and bond mix. With stocks, you have much higher range of volatility. With bonds, it's much lower. And so depending on the amount of risk overall you want to take, you might have a certain percentage in stock and a certain percentage in bonds, and they act as a counterbalance. Stocks are doing really well, then that's great. Generally, when stocks do well, bonds don't do as well. And then if stocks are doing poorly, bonds generally do better. So they can kind of counterweight the impact one way or the other. Okay, so stock and bond mixes, you hear that commonly. You look at investment portfolios and things like that, and they always have, hey, this is a stock fund, this is a bond fund, this is a mix, this is the percentage mix. And so we'll talk more about those details, but that's what bonds are. Hope that makes sense, and we will see you guys in the next video.
Balance your portfolio. Balance your peace of mind.